Hello, Mike Swanson here. I want to talk with you today about exchange-traded funds. Odds are you've got exchange-traded funds in your portfolio right now. I do, and I trade with exchange-traded funds. In fact, I have an entire model rebalancing portfolio system that's based upon them. However, I've been thinking a lot about exchange-traded funds over the past couple months because a virtual mania has developed in the financial markets centered around them. And on closer examination and digging into them, there's things about them that people really don't consider. There's really hidden costs to buying and holding exchange-traded funds that could have detrimental impact on the returns in your account or investment accounts, whichever the case may be, going forward. And I'm actually starting to change the way I do some of my investing because of these hidden costs. They simply may not be as good as you have been told they are. Now, right now, we are in an ETF Mania. There is absolutely no other way to put it. As I'm doing this video, it is March of 2017. When Donald Trump got elected president back in November, the stock market averages broke out. The Dow went through 20,000 and tons of money flooded into the stock market from small individual investors, and money shifts also took place from institutional investors. But as you can see in this chart, more money has gone into exchange-traded funds in the first 3 months of 2017 in any 12-month period in the years prior. That's a mania. There's no other way to put it than that. There simply isn't. And people, there's been recent news stories, two in particular, that's actually helped influence this. One is that Warren Buffett has made statements this year to the effect that you should get into so-called passive investments, which exchange-traded funds are the most popular ones. These are investments in which the positions in it are not actively managed. They're just held, and that's what exchange-traded funds do. For example, the Dow Diamonds holds the 30 stocks of the Dow. It does nothing but that. And these funds, the exchange-traded funds, they pay lower management fees than your typical investment advisors are going to pay, lower than a hedge fund pays, lower than a mutual fund pays. Investment advisors and mutual funds typically pay 1 to 2% management fees. These ETFs pay lower than that. And that's why Warren Buffett has made these statements that have really caught on with people that, hey, just forget your investment advisor, put your money in exchange-traded funds, forget managed money. And pension funds have actually been doing this. A lot of pension fund money traditionally has been placed with select money managers the pension fund manager picks, or even hedge funds, which charge typically 2% on the assets and then a 20% fee on the gains. Those are big fees. And last year, hedge funds lagged the stock market averages. They were only up like 3 to 5% when the market went up more than that. So a lot of pension funds said, why are we paying the hedge fund managers? And they took their money out and put it into passive investments, and that's contributed to this big money flow going into the first couple of months of this year. So it's created this mania with exchange-traded funds. And there is a benefit to exchange-traded funds. First, they require no work. It's so easy, right, to just go to your brokerage account, type in something or press a button, and shift lots of money into an exchange-traded fund without hardly any thinking, without any work at all. Just press the button, and you can literally shift $1 million just like that in seconds. That's so easy to do. And some ETFs are truly unique and do special things that it's hard to do otherwise. For example, there's ETFs that will invest in a basket of commodities that are all trading in the futures market. To do that yourself, you'd have to go open up a futures account. You'd have to do futures trading, which is intimidating and complicated, and for most people, and it's easier just to buy the ETF. Or you may want to short stocks. Instead of picking out 30 or 50 stocks, you buy an ETF that short stocks for you. Or these leveraged ETFs, 2 times and 3 times ETFs, they're not really good to invest in because they all have decay factors that I've talked about in the past that cause them to lose money when the underlying index that they're tracking is merely going sideways, but they move fast. And that attracts people who want to trade and people who even want to make gambling type moves in the markets. But the bottom line is all these things I've stated are the main benefit of ETFs. But the biggest one, of course, is it's so easy to press a button and shift money into one of these things. And you just see a ticker, and you see the symbol, and you see the price action. And typically when people are playing with ETFs or buying ETFs, that's all they focus on. They don't even really think about anything but that. They don't stop to ask themselves, usually, what is actually in the ETF? And that's what I'm going to show you. When you do ask that, you start to ask yourself then, is this really such a good deal all the time? Now, I'm going to say that some of these benefits, though, that are being talked about so much is actually a myth. The myth of low-cost ETFs. They still cost something, right? Yes, they don't cost a 1.5% management fee or a 1% management fee that you would typically get from an investment advisor or a mutual fund. So the cost is lower, but there still is a cost. These things are not free. And when you think about the cost and what you actually get, which is what I'm going to show you, then you start to ask yourself, why am I going to pay this? And I'm going to show you an example right here. XLF is a financial ETF. It's become, since the election of Trump, and as I do this video, one of the top traded ETFs in the financial markets. A virtual mania has developed around this ETF. There's no other way to put it. Billions of dollars from individual investors have gone into buying this exchange-traded fund. It's something like the number of assets, the amount of money invested in this fund has gone up over 5 times what it was the day Donald Trump got elected, while the fund went up about 30%. That's to give you an idea of the massive money flow. And it only went up 30% because there's still a lot of insider selling and selling that goes on in the underlying stocks. The stocks didn't go up, over 5 times. But when we look at this ETF, it does seem like a good deal. The expense is only 0.14%. Okay, yeah. So in this case, those who say that ETFs are cheap, they're correct. 0.14% doesn't seem like much money. If you had $1 million invested in this thing, that would only be $140. That's really not much money, right? And it holds 67 stocks. So on the face of it, that sounds like a great way to diversify. 67 stocks with one purchase. So easy to do. So easy to just type the symbol XLF and press the button. In fact, I did that myself. Following the election of Donald Trump, I bought this ETF. I bought it, and it went up, and I was happy with those gains. For disclosure purposes, though, you need to know I sold it a couple weeks ago, a couple days, in fact, before the last peak in the stock market as I'm doing this video. And this ETF pays a 1.3% dividend. Now, personally, I decided to make a buy in the financial sector, but I also went outside this ETF and I bought individually some small regional bank stocks that were paying 5% dividends in some cases, but over 3% because I wanted more dividend yield. More dividend yield than I could get from simply buying this ETF, and that's a point I'm going to make to you. Let's look at what this ETF is made up of and ask ourselves, is this really as diversified as we think it is? Is it really the great deal we think it is on paper too? Well, Here is a list of the 5 top holdings in this ETF. Number 1 is Berkshire Hathaway, Warren Buffett's company. It makes up 11.15% of this ETF. So when you put $1 million, if you put $100,000 in this ETF, you're really putting $11,000 into Berkshire Hathaway stock. You may not know that, but that's what you're doing. Berkshire Hathaway stock pays 0 dividends, not 1 drop of interest will you get for buying that. I prefer to buy stocks that pay dividends rather than buy stocks that don't. They help to goose your returns over time. And if I'm making a choice, personally, between Berkshire Hathaway and buying, let's say, JP Morgan, which is number 2, and those are the only 2 choices I got, I'm going to go with JP Morgan. Because JP Morgan pays a 2.29% dividend as I'm doing this video. It makes up 10.7.9% of XLF. Wells Fargo makes up 8.6%, pays a 2.7.2 dividend. Bank of America makes up 8%. Citigroup makes up 5.56%. Here's the point, though. These are the top 5 holdings of XLF. Most of these holdings, if you forget about Berkshire, are paying a dividend over the 1.3%, which is XLF pays. But here's the thing. These top 5 holdings make up 45% of XLF. 45%. The rest of the holdings of XLF, which are 62 stocks, they all have less, XLF has less than 3% of the assets in each one of those 62 other positions on an individual basis. So this is what happens. Let's say I want to invest in XLF. It's a simple, easy way to invest in the bank sector. The bank sector was a hot sector after the Trump election. Unfortunately, I don't think, we're in a market that's going to go up for years. If this was 2009, we'd be in a different situation. But let's say I was going to invest in bank stocks with the notion of holding for over a year, holding for multiple years even. And if I'm going to do that, I want to get those dividend payments. And because it's going to help my return. It's nice to see dividends flow into an investment account. So I got choices. I could buy XLF. If I buy XLF with, let's say, $100,000, 45% of that money is going into 5 stocks. Is that really diversified? People who buy these ETFs think automatically I'm being diversified, but is that really good diversification? I would assert it is not the diversification that people think they're achieving simply by buying an exchange-traded fund in most cases. And these exchange-traded funds are different, and I'm going to show you some that aren't diversified at all. But the second question is, I want to get these dividends. And XLF only pays a 1.3% dividend. A lot of the bank stocks pay higher dividends than that. And if I just decided, hey, forget about XLF, I'm going to buy 10 bank stocks that pay dividends over 2%. And that's not hard to figure out to do and the work to pick those stocks out. It's just not. You can look for their price to book ratio now. You can look for their PE ratios. You can look at their growth prospects. An hour's worth of work looking at a sector to pick out 10 stocks instead of buying an exchange-traded fund that's sticking half the money in 5 stocks. Just pick out 10 yourself that are paying 2% dividends or higher, and you buy these stocks in on an individual basis. You type the orders in. It's 10 orders instead of 1, but you're not going to pay that 0.14% management fee. Again, let's just assume you had $1 million. That's $140 charged a year. Let's say you're going to hold this for 10 years. It's $1,400. The difference that you're saving yourself by picking out stocks yourself, other than buying the ETF, and you're going to make more in the dividends. So that's where the thing really adds up. And And when you look at these ETFs, in this case there's 67 stocks in this one, you can easily see a couple stocks you don't want to own at all. I mentioned Berkshire Hathaway as a stock I really don't want to buy myself because it doesn't pay a dividend. But there's some stocks in here that don't pay dividends that are bad companies too. And you may say to yourself, well, picking out 10 stocks, what if I pick out the wrong ones? Well, pick out 15 or 20 then. The more stocks you pick out, the more diversified you're going to be, of course. But, this thing's got 50%, 45% in 5 stocks. Let's look at another ETF. This is the Jets ETF. It's an airline ETF. It charges a 0.6% management fee, a higher management fee than XLF. XLF actually has one of the lowest management fees. The Jets ETF is kind of typical for an ETF that's focused on one narrow sector of the market. In this case, it's airlines. It also pays a 0.55% dividend. In effect, it turns out on an annual basis then is if you buy this ETF, the management fees are higher than the dividends that you're going to get paid. So you're actually going to lose a fraction of a percent of the money that you have invested in this thing. If you want to invest in airlines, maybe that's not such a hot idea. But let's look at the holdings here. Again, 50% of the holdings are now in 5 stocks. 13% is in 1 stock, Southwest Airlines. 11% in number 2. 11% number 3. 4, American Airlines has 10% holdings. So when you look at it that way, 45% of just about of the holdings are in 4 stocks. That is not diversification. People who buy this, the rest is spread out in 20 stocks. This ETF holds 20 stocks, but 45% of the money is in 4 of them. That's not diversification. It's not. And recall, this ETF is only paying a 0.55% dividend. Well, Southwest Airlines dividend is 0.76%. Yes, United Continental has a dividend of 0, but Delta pays 1.7%. American pays 0.96%. Alaska pays 1.27%. So there's individual airline stocks paying dividends over 1%. If I want to invest in the airline sector, I would assert that instead of buying this ETF, I'd be better off picking 5 or 6 stocks out that pay decent dividends of higher than the ETF pays. I mean, that just makes sense. I see no rational reason to buy this ETF as an investment to hold for a couple years or more than 12 months even. If I want to buy stocks as an investment, I want to get the dividends, I want to get the management fees low. Yes, 0.6% doesn't sound like a big management fee, but multiply that by 10 years and it is. And multiply that by 20 years or 30 years. Not just in this ETF, but all ETFs in an account, the fees are going to add up. So the idea that ETFs are a way to escape management fees isn't really true. The typical investment advisor charges 1%, sometimes 2%, but let's say 1%. Well, you're only cutting the fees in half in that case by getting into most of these ETFs. Yes, XLF has a very small management fee, but most ETFs are around 0.5%. So this isn't the hot deal as an investment standpoint people are thinking it is. You're better off, I believe, I've come to the conclusion that I'm better off if I want to invest in a sector such as airlines to pick out individual stocks in that sector myself that pay higher dividends than the ETF does, and I'll escape the management fees. That said, when would I want to use the Jets ETF? Possibly if I want to trade. If I don't want to invest in a sector for a year, but I just want to trade for a couple weeks or a couple months, then I can see I'll just buy the ETF. Because in that case, if I just want to trade on a short-term basis, then I might be better off buying one ETF, doing one trade, paying one trading commission, than trading 10 things and multiplying that one trading commission into 10 trading commissions. In that case, it might be cheaper to pay this management fee here than the trading commissions that would be incurred from trading, dozens of individual stocks jumping in and out. So to my thinking, the frequency of trading plays in a factor of whether you're better off trading the ETF or investing in a basket of stocks. And so I've come to the conclusion myself to do both. And because I want to have core investment accounts where I'm escaping the management fees, getting higher dividends, and over time, that's going to add up for more profits for me. And in the fear people have of, I can't pick out stocks, or what if a stock blows up? Well, these ETFs are so focused on a group of stocks so often that, that's they're not as diversified as people think they are. But ETFs, I still do believe, are good for trading. They're good for more short-term positioning, and there are some ETFs that do special things. So I've come to the conclusion that for buy and hold investing, ETFs aren't always better than picking out stocks, and I'm going to be picking out and buying more individual stocks myself going forward. You, I think, should, after watching this video, think about the things I'm saying, take a walk and think about it, and it may change the way you approach your trading and investing. And just remember, these fees add up over time. They add up. 0.5% of your money. If all you do is have all your money in ETFs, 0.5% a year is going to add up. It just is. And there's nothing about escaping that. Well, let's take a look at GDX, because that's the gold stock ETF. It's also a very popular ETF. It's an ETF as I'm doing this video, I own a position in. But I think it's a great ETF for trading. It moves up and down very quickly because gold stocks are volatile. But is it so good for investing? Is the GDX ETF a good alternative for buying and holding individual gold mining stocks over a couple of years? Because I think we're early in a bull market here. And I'm going to say it's not. And again, let's study the situation. GDX pays a management fee of your charged management fee of 0.5% every year. So let's say I had $100,000 in GDX. So that's $500 that's taken out of my money to pay that management fee every single year that I'm owning this thing. And it pays a dividend of basically 0.25%. So in other words, if GDX and the underlying gold stocks don't move at all, if the gold stocks that are in GDX just opened January the 1st at a certain price and they didn't move at all, you're going to lose 0.25% because the management fee that it charges is greater than the dividend. That stinks. That said, it's a good trading vehicle, but I'm talking about real investing here. Investing where you hold. You think, I'm going to have a core position in mining stocks because I believe in the sector and I want it to, I want to invest in it for a couple of years. Well, let's look at the holdings. How diversified is this thing? Again, the same situation pops up as it does with most ETFs. Barrick Gold makes up 11% of this thing, Newmont 9%, Goldcorp about 7%, Newcrest 6.7%, Franco-Nevada approximately 6%. We're now looking at the top 5 holdings of this fund are making up 40% of the fund. Well, what's to stop? And here's the thing. Each one of these holdings is paying a greater dividend than the 0.24% management fee that GDX is paying. So if I went out and I just said, okay, I got $100,000, I'm going to put half the money in these 5 stocks and then pick out 5 more mining stocks or 10 more mining stocks that all pay dividends of some sort or another, I would escape the management fee of GDX and I'd get higher dividends. And that's not hard to do, right? GDX itself, after those top 5 stocks, it owns 7 stocks, where it puts 2 to 3% of the money in it, then 20 more stocks with less than 3%. Most of those stocks don't pay dividends. Some of them do, but a lot of that 20 at the bottom don't. You could literally cut them out and just buy only the top 7 that are paying decent dividends, and over time, as an investor, from year after year, you're going to get higher dividends, and GDX is going to pay. You're going to escape the management fee. You'll probably beat the return that someone that's holding GDX is beating. So that's a lot to think about. And I'm in one of my accounts the other week, I decided I'm going to use this account to take an investment position in gold mining stocks, a position I want to hold for the next couple years. And in this account, I bought 15 mining stocks. Instead of buying GDX, I bought 15 mining stocks. And I'm expecting to get nice dividends from this and beat the management fee that GDX holders are being charged. Now, in other accounts, I still got GDX. I'm even, as I'm doing this video, considering buying more GDX as a swing trade potential setup here, but we'll see how things play out. But it's funny what ETFs have done, how they've changed the trading world. When I first got into trading, there were no exchange traded funds. People traded stocks primarily, and then they had mutual funds. And then when the ETFs came, a lot of people saw them as good trading vehicles, especially the 2 times and 3 times ETF, because they move so much. They like to gamble it up. Now, over the past couple months, we've seen money just flow into exchange traded funds, not as trading vehicles, but as investments, as so-called passive investments. That's why there's been this massive money flow since the election of Donald Trump in the first 3 months of this year into these things, as people are piling into the stock market. And instead of going to their investment advisor and giving them money, or going into a mutual fund, getting them to pick out their stocks, they're trying to escape the fees they'd be charged from those activities by buying the ETFs. But they're still getting charged fees when they're not thinking about that, and they're not really understanding what these funds are holding, and they're not as diversified as they think they are. That's a situation, I think, when the next bear market comes, is going to be bad for people. But that's a story for another time. Right now, the purpose of this video was to drive home to you the fees these ETFs charge, and the fact that they're not well diversified as people think they are, and the fact that if you pick out individual stocks yourself that are even just in the ETFs, cut out half the holdings, just to examine what's in there, you can get higher dividends than you're going to get from this. I mean, look at this dividend here. 0.25% stinks. I can pick out stocks that are paying double the dividend easily in the mining world. That's what I did. I bought 15 stocks. And I plan on buying more mining stocks and junior mining stocks as time unfolds, because we are going to see dips in gold stocks. That's what they do from time to time. But in a real cycle, there's opportunities to accumulate. There's opportunities even in the junior mining sector and so forth, and that's all stuff I'm excited about. But GDX is not like, in itself, it's not like, hey, that's not necessarily the best way to do this from an investment standpoint. Just throw money at GDX. And it's the same thing with any sector in the market. Oil stocks. I'm not interested in oil stocks now, but one day I may be. Good chance I will be. And I'm not going to buy that XLE ETF as an investment when that day comes. I'm going to buy individual oil companies because you can get bigger dividends. And these management fees add up. I don't like it. So, you could take everything I talked about in this video, apply it, and save yourself a lot of money from these management fees over the years, and potentially make higher dividends and returns. So a lot to think about with you, and I'll be talking with you later.